everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today to discuss a very hot topic, budget reconciliation, and what it means for tax policy in the coming months. Today's event is another in Tax Analysts series of public discussions, Taxing Issues. We launched this series to encourage debate on tax issues, and through the series, we will continue to bring the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy and administration. As always, we welcome your feedback on how we can make our webinars more useful, as well as your suggestions on future webinar topics. You can send your feedback and suggestions to events@taxanalysts.org. We also welcome your questions for today's event. Please use the chat feature to submit questions during the webinar. I will begin by asking the panelists a few questions before turning to questions from you, and I promise to get to as many of them as time permits. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the poll questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comment section. To receive credit for your answers, you need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you will not be able to see the questions if you expand the program to full screen. The course materials, which were sent out in advance, are also available for downloading under the viewing window. Now, let's talk about budget reconciliation, which will be at the center of this year's debate over taxes. The reconciliation process was actually created by the 1974 Congressional Budget Act. Under it, if Congress adopts a budget resolution, which is essentially a budget outline for the coming year, and that resolution gives instructions to various committees to write bills that would raise or cut revenues or spending. Because most of us are focused on taxes, we naturally care about what the budget resolution directs the House Ways and Means and Senate Finance committees to do. But why is budget reconciliation so popular, especially in the first year of a new president? Well, it's because reconciliation bills that contain all those changes to revenue and spending programs can't be filibustered. That means that unlike virtually every other piece of legislation, a reconciliation bill requires only a simple majority to pass the Senate, not the usual 60 votes. So as you can imagine, presidents who have slim majorities in Congress, as President Trump now does, like to push their major legislation into law through the reconciliation process. Sometimes we see one big reconciliation bill in a year. Other times, for technical or other reasons, we see more than one. And since 1980, which was the first year that a reconciliation bill was enacted, presidents have signed into law 23 reconciliation bills, and they have included some of the biggest changes to domestic policy in recent decades. They include the 1990 and 1993 deficit reduction laws, the 1996 welfare law, President George W. Bush's tax cuts, Obamacare, President Biden's American Rescue Plan, the Inflation Reduction Act, and of course, the 2017 Tax Cuts and Jobs Act. Well, as you know, much of the TCJA is scheduled to expire at the end of this year, and both President Trump and congressional Republicans want to extend it in some form, though they may differ a bit on some of the details. Presuming they can agree on a final tax bill this year, they will undoubtedly advance it through the reconciliation process. But we're a long way from there. We're also a long way from the original purpose of reconciliation a half-century ago, which was to reduce budget deficits, not add to them. But I digress. So what will happen during reconciliation this year? Will lawmakers enact, in the words of President Trump, one big, beautiful bill? Or will there be multiple bills? And more importantly, what will be in the bill or bills, and what will they cost? We have a lot to cover, and we have an excellent panel to explain the process and to discuss and debate the issues. Let me introduce them. We have Erica York. She is Vice President of Federal Tax Policy with the Tax Foundation. Chris Towner is Policy Director for the Committee for a Responsible Federal Budget. And Patrick Dreisen is a tax notes columnist and former Joint Committee on Taxation and Treasury Department economist. I want to thank you all for joining us today. And let's jump right in. So, Chris, I talked briefly about reconciliation, but there's obviously a lot more to it than what I said. Could you walk us through the requirements of reconciliation and sort of explain how that differs from a routine legislative order?
Yeah, absolutely. I think you did a really great job of introducing it. And I'm going to stress again, budget reconciliation is meant for reducing deficits. For the first, 25 years that it was around, we used it to reduce deficits. It's only been since, the last 25 years or so that we started to use it to enact other policies that increase deficits. But the budget reconciliation process is a really convoluted and a not fun way for lawmakers to actually make policy. You have to start with a budget resolution, and you have to agree with it in both chambers. And that only unlocks the then legislation that you can then write. And then you come together and make sure that it complies with that budget resolution's instructions. There's also a lot of other rules like the Byrd rule, I'm sure we'll get into a little bit more. But really, budget resolution is meant to decrease spending levels and increase revenue levels. But really, what we've seen is that quite the opposite over the last 25 years or so. Now we use it to do temporary policy mostly because there are some strict limitations on what you can do, and everything has to be budgetary. So you have to have produce a measurable change in outlays or a measurable change in revenues in order for it to be included in budget reconciliation legislation. And that gets into a lot of issues. Most policymaking, while it does have some kind of component that's either spending or revenue, it's not the intention. So it has to be at the heart of what the budget reconciliation legislation is doing. It has to be changing those budgetary levels. So I think that's kind of like the 100-foot level looking at it. I'll just say in the current step of the process, the House has passed its own budget resolution. The Senate has passed its own budget resolution. Looks like they're going to put the Senate budget resolution by the wayside and work off of the House's. And this is the most important step for the fiscal impact of the bill because it tells us how much they can allow themselves to borrow over the next decade. We're trying to push that number as close to zero or even make it negative. It's been negative in the past. The current House reconciliation budget resolution allows them to add about $2.8 trillion in deficits over the next decade. And, it's a really terrible time to be doing that. Debt as a percentage of the economy is about nearly 100%. We're going to exceed our levels after World War II in just 4 years. And interest payments on the national debt are already larger than we pay on just things like national defense and Medicare. So it's a pretty bad time to be adding significantly to deficits.
Thanks, Chris. So, Patrick, and I think Chris kind of alluded to this. No, we've used reconciliation to enact a lot of major tax laws in the recent past, but things feel different today in 2025. From your perspective, how are things different today as we're using reconciliation to enact a major tax law than they may have been in 2022 or 2017?
Yeah, Kara, I think as we all can feel and know right now, this 2025 is not a normal year. But I should say that most most bills, including tax bills, and the subset of those that are reconciliation, depend on a framework, a budget foundation that CBO establishes usually at the beginning of the year. The foundation we have now for the House, for the House thing that just passed was published on January 17th. It was worked on a lot last fall, probably as recently as late fall and then into December, but it doesn't include anything that's happened in the last 7 weeks. And for purposes of assumption about what the administrative policy is, it's much of it is a continuation of the policy of another party. So, and that's not different, I should say, than 2017 when you had a changeover in party. But the difference is the huge number of things that have come into play in the last 7 weeks and look like they're going to come into play throughout the next year and maybe into 2026 for sure. And that makes that CBO foundation dated right away. We're only 7 weeks in. It's not CBO's fault. It's not necessarily a fault of the procedure. It just happens to be how active and ambitious the administration is combining that with the tax bill at the same time. And so and I should say that CBO forecast includes a macro forecast, a revenue forecast, and an outlay forecast. And all of those, again, not CBO's fault, but all of those I would think are obsolete by now, unless by coincidence they all happen to be the same as what people thought back in December. So this is way different than 2017, way different even than 2022 when the reconciliation was used for the Inflation Reduction Act, even though that one also had some dating issues.
It's going to be fascinating because you're right. Everything is going so quickly at this moment. Chris, I want to do one other little bit of table setting, and then I'm going to turn to Erica to talk more in depth on the House budget resolution. Chris, can you just walk us quickly through the Byrd Rule? You mentioned it earlier, but just talk us through that a bit and its relationship to reconciliation. And if you have examples, it would be great to mention a few types of things that have been stricken in the past by the Senate parliamentarian.
Yeah, absolutely. I think the Byrd Rule is probably the most limiting factor on reconciliation legislation, because it essentially decides whether or not something is privileged or not to continue through the Senate on a 50-vote majority, right? Most legislation passes with large bipartisan majorities. It has to go over 60 votes in the Senate in order to avoid the filibuster. Budget reconciliation has privilege, and the Byrd Rule kind of monitors whether something complies with that privilege or not. So there are 6 real provisions, but I'll just talk about the most important ones. One is that it has a provision in the reconciliation legislation has to produce a change in outlays, or a change in revenues. It has to have budgetary impact. The second part of that is that both of those have to be the intention of the policy. It can't be a side effect of the policy. It's because you want to make changes to spending or revenue levels that this policy is happening. And then the third big one, and I think it allays some fears about reconciliation, is that you can't touch Social Security in reconciliation. Very generally, that one can get more complicated because you can affect payroll tax revenues. However, you cannot directly make changes to benefits or changes to the revenues that like the way that the tax system works going into the Social Security Trust Fund. So a good example of things that have not been able to be included in reconciliation because of the Byrd Rule is in 2021 when the Build Back Better effort, before it became the Inflation Reduction Act, they were talking about trying to include immigration reform and an increase in the minimum wage. So the immigration reform would have used leftover visas, temporary work visas, and being able to pool them together so that you could, expand the legality of, especially a lot of like dreamers. I think that's what a lot of the intention was. Parliamentarians said, this would actually reduce deficits. However, it is not the point of your policy. So it's extraneous. It's not a budgetary matter. You cannot include that in reconciliation. Another example for the minimum wage is that Democrats wanted to raise the minimum wage to at least $15 an hour, the federal minimum wage. Parliamentarians said, yes, that actually also would change federal spending and revenue levels. I think it would reduce deficits by about $50 billion. It might be the opposite. It might be increased deficits by about $50 billion. But either way, it did result in budgetary changes. The issue was that had nothing to do with it wasn't a budgetary intention, right? So because that was not intended by the policies change, you couldn't include it. And this most significant, I think, part of the Byrd Rule that I'd be remiss to not mention is that you can't increase long-term deficits. So the way that we describe that is by deficits outside of the budget window. So the current budget resolution that they are arguing over is the 2025 to 2034 budget window. So that includes the current fiscal year. It also includes a year in which you actually don't have to extend any tax cuts because they're already in place. So you cannot increase deficits outside of 2034. If it increases deficits after 2034, that violates the Byrd Rule, and that could risk the entire bill, or you can make surgical changes to the bill to make sure that different provisions are not increasing those deficits. That is really the key to permanence here. You cannot do a permanent tax cut or a permanent change in policy unless it's fully offset after 10 years. So you can increase deficits within the first 10 years, but you certainly can't outside those 10 years. So I think that's probably the biggest stick in the craw right now on trying to get through budget reconciliation legislation, because the idea, especially for tax cuts, is permanence. You want permanent policy for assuredness.
Yeah. Yeah, that is going to be a challenge. Erica, now that we have some background laid, I really want to get into where we are today. So in February, the House passed an FY25 budget resolution, which essentially started this reconciliation process. Could you provide some background on that resolution and what was included in it? I'd also be interested in getting your take on some of the items that were in the resolution.
Sure. So like Chris mentioned, that House passed budget resolution would permit a deficit increase within the 10-year budget window of about $2.8 trillion. That's comprised of several moving pieces on both the tax cut side and the spending reduction side. As far as the audience interest here, probably very interested in the instructions for Ways and Means. And there they are permitted to increase the deficit by $4.5 trillion. So that roughly lines up to the 10-year extension cost of these expiring tax provisions. You'll note that it falls short of the cost of any additional tax cuts like those that Trump proposed on the campaign trail, various exemptions for different types of income or activity from tax would be on top of that $4.5 trillion, so would need to be offset. It also outlined $300 billion in spending increases for certain committees, specified $1.5 trillion of savings across other committees, and then has $500 billion of unspecified savings. That's how you get to this net effect of $2.8 trillion in the deficit increasing. There's an interesting interaction, though, with that unspecified $500 billion and the requirement for this overall level of savings. If lawmakers fall short, then it reduces that deficit allowance for Ways and Means dollar for dollar. If they find more savings anywhere, it would increase that allowance for Ways and Means. So the net deficit impact remains the same, but the moving components can change, and if there's more savings found, can perhaps permit more tax cuts or changes from Ways and Means.
So interesting. Before we move on, I was going to move to budgetary accounting. Before we do that, Chris and Patrick, I want to kind of get allow you to give your opinion on the things that were included in the budget resolution.
Patrick, I defer to you first.
Well, I mean, I think we're at the stage where it's extremely vague. Although there was something interesting that came out today. Yale Lab actually did a distribution of the tax cuts and the benefit cuts, hypothetical. And I think that's the kind of conversation, sort of inclusive conversation, both of tax cuts and budget cuts, we want to begin having. Obviously, those certainly the benefit cuts, actually neither one have been specified, but you can use sort of a TCJA continuation on the tax side and feel a little bit comfortable, unless you got overtime, Social Security, live abroad, or going to actually buy a car. I think I'm missing one there too, in terms of the extra stuff that's coming in. It's on the benefit side that I think we have even bigger holes. Some people have looked at the amount of money that's charged to the various committees and said, well, you can't do X without doing Y. And those are some interesting conversations. I think all that's good stuff to start talking about. I don't think what the Yale Labs did today, for example, is set in stone, but that's a great conversation to have. My feeling was in 2017, some of the discussion of possible government healthcare benefits got laid on at the end and didn't really become part of the full legislative discussion. So I kind of like what happened. I would say we do have sort of open boxes at this stage.
Yeah, I'll just add on to that it's kind of mind-boggling that at a time when we're borrowing about $2 trillion a year, deficits are basically the highest they've ever been outside of a non-war, non-emergency period. Our debt is higher than it's ever been outside of being right just after World War II and expected to go up pretty dramatically. We're talking about borrowing an additional like nearly $3 trillion, right? Actually, we've done the math and, under like it depends on the path of the costs, but we're talking about maybe adding $3.5 to $4 trillion to the debt over the next decade. And there's the only amount of savings they can get is $1.5 to $2 trillion of savings. And, the elephant in the room is that most of the spending that we're going to incur over the next decade is from Social Security and Medicare. And if you can't touch Social Security and reconciliation, and if you're limiting yourself from touching Medicare, then you're just not going to find that much savings. Like the logical next answer is that you're going to add a lot of that to the debt. So, I mean, it's just it's totally irresponsible. It doesn't matter which party is in charge right now. Obviously, the tax expirations are a huge deal, but we should be talking about how to either make them not add to deficits at all, or how to actually reduce deficits. And there's a lot of ideas out there that you can do revenue neutral or even revenue positive reforms. We could be using this as a good opportunity to reform the tax code rather than just an extension or increase of even more tax cuts. It's just, yeah, it's mind-boggling.
Chris, I appreciate that you didn't use the word boomer.
Erica, the Tax Foundation has done a lot of good work in this area as well, and looking at what are your thoughts on the amount of additional dollars that we're going to add to the deficit with the current spending?
Yeah, like Chris mentioned, we've authored 2 different revenue neutral plans that would extend most of the TCJA expirations, but also find offsets within the tax code. So if you go through, Treasury or JCT's tax expenditure list, you'll see we have a lot of room for revenue raising even on the tax side, before you even get into the spending side, that could be harmonious with tax reform. It could simplify the tax code. It could get rid of differences that we have across industries or across individuals and the different ways people earn income. So it would certainly be possible and would be an improvement to aim for revenue neutral tax reform. If you look at the combination of policies being considered just on the TCJA expiration side, of course, the biggest driver of that 10-year cost comes from the individual side, the individual tax cuts. The business extenders add a little bit more, the estate tax adds a little bit more as well. But then if you look at economic impact, most of the long run growth that you would anticipate from making these tax changes permanent comes from those business provisions. So I think one thing that goes hand in hand with fiscal responsibility would be prioritizing the most pro-growth tax cuts, and then again looking at ways to offset the cost of the others, or potentially just focus on those pro-growth provisions and allow the ones that don't contribute as much to growth, that do contribute a lot to the deficit, to expire as scheduled.
So, Chris, now I'm going to turn on to a nice geeky topic, and this is something that has been certainly in tax notes a lot. It's also been in the mainstream press, believe it or not. But let's talk about budgetary accounting. And can you talk a little bit and explain what is meant by current policy baseline versus current law baseline, and also why the baseline chosen is important to the conversation?
Yeah, absolutely. I mean, this is a big topic that we've even focused on here. We had a great event last week at CRFB about this. So the way that the congressional scorekeepers generally score every law or bill that comes forward is on a current law baseline. So it assumes that all current laws will remain unchanged, and whatever change in policy you're trying to make will affect that baseline. So right now it assumes that the entirety of everything that expires at the end of 2025 is allowed to expire, and thus we get lower deficits over the next few years because we don't have those tax cuts anymore. A current policy baseline, on the other hand, would assume that those things that are allowed to that are scheduled to expire are not allowed to expire, and in fact, our deficit situation is far worse because we have about $400 to $500 billion of annual deficits increases, larger than what CBO is projecting under its current law baseline. Now, why this is important is really, it's just a budget gimmick to talk about whether you're using a current policy baseline or not. the current policy baseline, to comply with reconciliation rules, you cannot add to long-term deficits. So if you assume that all the current policies have no costs because against the current policy baseline, they're not scheduled to expire, then you can extend those policies indefinitely without having to face any scorekeeping issues. The only exception to that is you do have to make some change to it. You either have to, you probably have to slightly reduce the cost of them in order to make it so that its scores is, deficit reducing. Because again, Byrd rule requires everything to score. The proponents of a current policy baseline are saying, it doesn't make sense. Why would we just assume that taxes are going up next year when, people have not been paying those taxes for the last 8 years? And I answer that by saying in 2017, that's what we decided. In order to fit with budget reconciliation rules, all of the tax cuts were pretty much all the tax cuts. I mean, the tax cuts that they wanted to make permanent were made permanent. The corporate income tax rate was reduced permanently. But all the others were set to expire at the end of 2025. So in order to account for the cost of extending those, we really do have to use a current law baseline. Otherwise, if you're using a current policy baseline, you're just having more borrowing, and you've never had to even reconcile with that kind of cost. It's very wonky, and it's mostly being pushed by interests that don't want to go through the hard process of figuring out what are the proper offsets, or how do we put in place, a deficit reducing package that we can do permanently. A lot of the proponents like to tell me like, oh, well, we can't do permanents otherwise. You absolutely can do permanents otherwise. You just have to fully pay for the policies that you want to do. And that's why we have Obamacare today, right? In 2010, it was fully paid for when they passed it through reconciliation. Now, a lot of those pay-fors have since been repealed, but nonetheless, at that time, we scored it as deficit reducing. And if we want the TCJA to be permanent, we should do that as well this time.
It's just so much harder, Chris, to do it this way. I digress. Erica, in your opinion, could we use current policy baseline and have it be consistent with reconciliation and the Byrd rule?
Whether we can use it will depend on like how the Senate parliamentarian rules, if it gets brought before her for that. But then one of the issues that Chris just brought up will be really interesting. Let's assume that we are in a world where current policy baseline is permitted. Then just extending the TCJA has no cost against a current policy baseline. So you'd have to go through and change each little provision. And for some things, that's pretty straightforward, like where the brackets kick in. You can change those dollar thresholds, and then that has a very obvious score. For something like eliminating personal exemptions or suspending the P's limitation, then the question becomes, are we going to bring back like really small personal exemptions? Are we going to have a very small P's limitation? And it gets very tricky and obviously doesn't add up to like sound and good tax policy design. It is then becoming tax policy design to comply with the Byrd rule, which is not a good way to be crafting what should be a tax reform. And then I think to Chris's point too, using a current policy baseline doesn't change the actual path of deficits of our debt if we do extend TCJA. It simply just changes the number that we're like attaching to this piece of legislation. It doesn't change the cost in the real world. And so if lawmakers are wanting to be fiscally responsible, then they need to deal with those real world costs of extending the tax cuts rather than just pretending on paper that they don't exist.
Kara, can I add something?
Absolutely.
Little minor, maybe librarian stuff for future generations. Who I do worry a little bit 20 years from now, if we do current policy, who's actually going to figure out whose responsibility it was, which Congress's responsibility it was back in 2025. Sounds a little bit spacey, but actually a related matter that may bite is that if you're assuming current policy, you may not get an official income distribution. So we obviously have a lot of people doing income distributions, and that helps. But the official one, which is the one that they use during debates and everything else, if there's no change in policy, there's probably no change in an income distribution. Now, a lot of people like that because that's a very messy area, but I don't think that's a place we want to be down the pike. I hate to admit I did maybe 3,000 estimates back in the day, and I'm I'm sort of I'm not proud of a lot of it, but I'm proud of never having used a current policy baseline. But maybe I was lucky enough because I was at Treasury when they didn't do current policy, and then I switched up to the Hill, which up to this year has faithfully always done current law, and it should be written in like one of the maybe the 11th commandment.
Just to
Interesting.
add quickly onto that too, because another point, I think that Patrick, you kind of alluded to it too. Doing a current policy baseline would open up us to a world of budget gimmicks. It would totally set new precedent. You're essentially eliminating the filibuster. Like, I don't see why you have a filibuster if you can just pass a policy temporarily and then extend it at no cost. Like, I don't, everything that Democrats wanted to do in Build Back Better, they set up like a million different expiration dates. They would just be able to do a costless extension under current policy. What's the point of having any budget rules if you're just going to break all of them at once? You might as well break the filibuster if you're going to go along with that as well.
And
That's a
Karen,
good
this is the thing. This is the thing we said we wouldn't talk about.
Well,
7 minutes in.
it's a good conversation to have, and I think it's an important one. Chris, one last question on this, and then we'll move on to Patrick, and I want to talk about dynamic scoring. But do you have any sense of whether the parliamentarian will allow the use of current policy baseline?
Yeah, it's unclear. That seems to be what the House and Senate are trying to figure out over the next couple weeks as they're trying to have discussions with her. My understanding is that she does not like to make decisions on anything unless it's ripe, which means it's come before her and with live legislation. Though I will say that talking to former staffers that were around in 2017, there was current policy at that time as well. It was about $500 billion of tax extenders that lawmakers wanted to use as current policy. And the parliamentarian was not okay with that. She said that you could not do the budgetary scorekeeping using current policy for that. So I don't think her opinion has changed, but if it has, like, that will certainly change the trajectory of what we're talking about. And it's also just unclear to me whether deficit hawks would go along with this as well, right? Like, there was a lot of hard-fought budgetary savings that came out of the House budget resolution. Now, it wasn't nearly enough. They should have paid for the entire thing, but $2 trillion of spending cuts is not $0 of spending cuts, and it's certainly more than the $500 billion that had been reported that they might originally try to seek. So I don't know why deficit hawks would go along with the current policy baseline as well.
Yeah, I can't imagine it. It seems across the board to be viewed as a budgetary gimmick. So it's an interesting conversation that doesn't seem to have a lot of support outside of probably the inner circles of those that need it. Patrick, let's talk about dynamic scoring, which is funny. I feel like I started hearing Marty Sullivan talk about dynamic scoring a decade or so ago. But can you explain the fundamentals of dynamic scoring and how the model takes into account macroeconomic growth?
Yeah, in my nightmares, Marty's talking to me in the 90s about dynamic scoring. But so there's a house rule, and interestingly, house only rule, and it's always been a house only rule that says that that asks CBO and JCT to do what is referred to as dynamic scoring if there's a more than a 0.25% change in GDP from a particular proposal. Now, it's not an absolute requirement because it asks if CBO can do it. So there's sort of a limitation and a resource issues. It's and I don't want to speak for CBO, but it's possible in the past they've said they couldn't do such and such. But there's nothing like that on the Senate side. Although the advisory nature of, and I should back up a second, that everybody in town who's doing revenue estimates is doing behavior. They are doing some level of micro dynamic behavior. They're also, oddly, at least at JCT, doing some macro dynamic behavior because at JCT, it's GNP that's fixed, not GDP. So technically, GDP can float around in JCT's conventional estimates. Now, one of the important aspects of this is not just whether it's rolled into a particular estimate or not. It's very useful on the Hill. And I think if we go back and think about 2017, even though the macro dynamic was not explicitly rolled into the scores, it was talked about a lot in terms of explaining and justifying at least some of the deficit increase it was sort of sold a bit by some as well, because we can't include a dynamic score. Some of that $1.5 trillion debt will be erased, even though it's not showing up here. I think there's kind of a side aspect which showed up in some of the tax foundation work, but also in some of the other things, which is I like to think about, can you get a revenue kick from the dynamic score that is equal to or more than whatever your change in interest costs, and because both of those things are actually usually left out of the scores, and if one can at least cover the other, then you can feel okay, we're even. I would say also with respect to the to some of the macro scores, Tax Foundation, especially for this year, has done something fairly interesting, and I would also say fairly brave. And they may have done it in the past, and Erica can speak to that. But they've actually assigned specific dynamic scores to particular provisions, some of them in particular detail. And the more you can look at that and think about that, you become you can become quite interested in the package you want to put together. And Erica, maybe you want to talk about that a bit.
Sure. Yeah. Thanks, Patrick. Yeah, we recently published a new analysis looking at extending the TCJA, all of the individual provisions, the estate tax changes, and what you could call like the 3 business extenders. So bonus depreciation, restoring R&D expensing, and going back to the EBITDA-based interest limitation rather than sticking with EBIT as it is now. And we produce, like Patrick said, line-by-line revenue estimates of that, as well as line-by-line GDP estimates, and then the resulting dynamic revenues from that. And what we found is kind of what I alluded to earlier. The provisions aimed at cost recovery tend to be much more pro-growth than other provisions, especially because those are aimed entirely at new domestic investment, so have a more powerful incentive effect than something, say, like a larger child tax credit that may provide a tax cut and a tax benefit to families, but doesn't have a powerful investment or work incentive built into it. And so what you'll see across the entire package, we estimate that over the 10-year window, 2025 included, so there's no revenue cost there, that the TCJ extension would reduce revenues by $4.5 trillion. On a dynamic basis, we find that 16% of that cost is offset by that larger economy, spinning off higher tax revenues elsewhere. So, one of the things we have heard some rumblings about, especially around this deficit increase allowed by the House budget resolution, is that most of that would be made up for by economic growth. What we find at Tax Foundation is that only about 16% of that total tax cut cost would be offset by economic growth. So that leaves you with still a very large increase in the deficit. We also produce estimates of added interest costs. And like Patrick said, the interest costs add a lot and offset much of that dynamic feedback. So on a conventional basis, we find that $4.5 trillion revenue loss. On a dynamic basis, with added interest costs, we find a $4.6 trillion increase in deficits plus interest. So you'll see, even with economic growth, higher interest costs because of that deficit financing add quite a bit to the overall cost of the package. Now, this would all look different if we also incorporated, the specific spending changes and how that would potentially reduce some interest costs. We will plan to do an analysis like that when we have legislative text that specifies, what spending reductions are actually agreed to, rather than just kind of outlined as a goal. So we'll see how it ultimately shakes out. But I think the key takeaways are that dynamic growth and having a pro-growth impact are important, but they are not a pay-for. So it's good to have a goal of a pro-growth tax package, but that's not going to offset the cost of trillions of dollars of tax cuts.
Erica, this was a question that came in from the audience. Has there been any discussion of including tariffs into reconciliation to allow that related revenue to affect the scoring?
That's a really great question. For tariff revenues to count, my understanding is they would have to actually be legislated. So if it's just administrative action, imposing tariffs. There's no official score for that included in the reconciliation package. Rhetorically, though, we may hear lawmakers say, we anticipate the Trump administration is going to bring in, say, $500 billion of tariff revenue or whatever number they want. And so they'll say, even though our package is increasing the deficit by 2.8 trillion, some fraction of that will be offset by tariff revenues from executive actions. The problem with that, though, is that if lawmakers are relying on those tariff revenues and they're also relying on a dynamic score, they would need to take into account the economic drag created by tariffs. And it very well could be the case, depending how far the Trump administration pushes tariffs and how much foreign countries retaliate, that the economic drag created by a trade war could offset the economic benefit of tax cuts enacted by Congress. So we could be in a situation with no dynamic revenue if we really see the trade war stuff ramp up.
Interesting.
Kara, I would just add to that I think this is all a good reason for why why someone would want to see an updated baseline. I'd want to see in the middle of the year, and this is unusual, and maybe not work off of it. Although I would think you would want to work off an updated baseline. In other words, use it as your reference point, not just as an information thing. I think in 2025, more than any other year, and whether you like the ambition of the administration or not, I would think you would want to know where you are, whether you're in a dark room or not. And tariffs are the perfect example, whether they do it administratively or somehow find a way to codify them. I want to see CBO, and yes, I want to see Treasury OMB, because I want to see them both. I just don't want to see one. I want to see both of those before I think about TCJA.
That's a great point. I'll just to add on to that, that there's really nothing that's causing lawmakers to act at the current pace that they are. There's no reason they have to do this. I mean, it's just their self-imposed deadlines. We have through the end of 2025 to finish an extension. And in theory, we could actually do a retroactive extension in the after 2025. It's all self-imposed deadlines in a period of great uncertainty. And just to also add on to what Erica was saying, like I think even CBO has put out that the tariffs that President Trump had proposed during the campaign would reduce the size of the economy by roughly the equivalent amount that Tax Foundation is estimating that extending TCJ would increase the size of the economy. So you're not getting any dynamic benefit then. Like, what's the point of trying to point to a dynamic score if the totality of the policies is falling far short and the House is relying on $2.6 trillion of dynamic feedback for its budget resolution, which no estimator is finding anything anywhere close to that.
Yeah.
Chris, I might add, maybe unlike unlike the other panelists, I could wait to 2027 or 2029. I mean, I can be patient enough. I'm not that wouldn't bother me.
Yeah, they let them all expire. I'm fine with that too.
I'm not sure it's unanimous.
Does anyone have a sense of Congress's likely timeline for passing a bill? I've heard that we're probably waiting until August or later. Does that resonate with the panel?
I mean, the House has identified a faster timeline for their goal than kind of what the Senate has identified, which is after August recess. Like Chris mentioned, this stuff expires at the end of this year, and so it's January 1, 2026 when taxes are slated to go up. Most people don't reconcile their taxes until they file it next year. The following year, that'd be 2027. So Congress could let the tax increases go into effect and then retroactively change it. Ideally, though, I think getting it done sooner rather than later is better, because then we at least have certainty on some aspect of economic policy. The tariff actions, the other executive actions we're seeing from the Trump administration are likely to remain very uncertain. But if we can at least get stability in our tax system, that would be a step in the right direction, though again has to be weighed against these other considerations. What's it doing to the deficit? What's it doing to debt? Does it actually improve economic incentives in the long run, or are we in just another world of a temporary extension that still adds to uncertainty.
So given what we know so far, and Erica, I'm going to keep with you and then let Chris and Patrick respond as well. What key reforms do you think are likely to be included in a reconciliation package? If you look into your crystal ball, are we going to have a complete extension of the TCJA or bits and pieces? What do you think is going to be in there?
I think for the most part, it's going to stick with the parameters of the TCJA. We'll see those individual tax cuts extended in some form or fashion, but I think there will be changes around the edges of all of those. Maybe something like inflation indexing, the maximum child tax credit, some type of change to the SALT cap policy. On the business side, there's bonus depreciation, there's restoring R&D expensing. There's also some consideration of maybe improved cost recovery for structures. So not far afield from what TCJA did, but just kind of moving in that direction a bit further. The big question marks in my mind are what happens to the president's tax policy proposals, like no tax on tips, no tax on overtime, no tax on Social Security benefits, which is a tricky one given the Byrd rule, but there are creative ways to, create some type of tax credit for seniors that could get at that goal. But those all add, of course, to the cost, potentially add trillions to the cost. There are ways that Congress could design those to be narrower, but then you run the risk of the president not being in favor of a narrower approach when he campaigned on these big tax cut ideas. So I think that's probably the most interesting area to watch, to see what happens to these things outside of TCJ that the president has promised that now is up to Congress to try to deliver on within the confines of reconciliation.
Yeah, I think that's going to be very interesting. Chris, I'm kind of interested in your take on this as well. And also if you have a sense of what pay-fors might be included in a bill.
Yeah, I mean, I'll second pretty much everything that Erica was saying. I think that that's spot on of what we're going to do. Most likely, I think path dependence, is really powerful, and there's the inertia is all behind that. Ideally, what we would be doing is taking a hard look at the provisions of the TCJA that were successful, what were less successful. I mean, in my mind, the SALT cap should absolutely not be increased, but maybe we do the opposite and we go around. There's a lot of SALT workarounds. I think like 35 states or something have put in place these SALT workarounds to help mostly sole proprietorships get around the SALT cap. I think we should crack down on those. We could be limiting corporate SALT in the same way. If we want to go for parity, there are some ideas that we've been throwing around, which is maybe you just like freeze the indexation of the tax code for a couple of years. That can save you pretty significant amounts, and it doesn't end up looking like a tax increase because people are paying the same amount of taxes as they were paying for the previous 2 years, essentially. But it does get you a lot of budgetary savings. I think on the offset side, congressional Republicans have really limited themselves in what they want to look at. I would imagine that the biggest thing that's ripest for savings are reversing a lot of the executive actions that the Biden administration put in place. So there were obviously, like, everyone thinks about the student debt cancellation, and that's not in effect right now. But there were other things around student debt. There was a very generous income-driven repayment plan that could be repealed or at least modified significantly so that it's not nearly as costly. That's like nearly $300 billion over a decade. Medicaid keeps getting a lot of talk. I think if they want to comply with the Energy and Commerce instruction for $880 billion of savings, there's virtually no way you can do that without touching Medicaid. But that doesn't mean to say that there aren't great reforms for Medicaid that don't really hurt beneficiaries. Right now, states are really ripping off the federal government when it comes to they use these provider tax gimmicks where they essentially are taxing a hospital and then giving the hospital back the payment and then saying, hey, federal government, we just paid the hospital. Now you have to give us match on that. That's a huge gimmick. And there's been a lot of conversation about tamping that down. Some of the more aggressive things like block grants and per capita caps probably won't happen. But really, Medicare is the ripest place for reform. And there's so many great ideas out there for getting at Medicare savings that don't hurt beneficiaries. It sucks that it's a third rail issue at this point, but like I don't think anyone can look at like a policy like site neutral payments. We pay doctors more money for doing something in a hospital setting than we do in a physician's office setting for pretty much no reason. I don't know why we wouldn't just do site neutral payments in general. But if you're going to limit yourselves from not touching Medicare, then you're going to have to go after some of these like much harder, much more politically salient, but also dicey things like SNAP benefits and Medicaid.
I think that's where we get gimmicks, is when you can't go after a main program, then you have to go around the edges, and that is sort of where gimmicks come up. Patrick, I want to get your thoughts as well on what you think might be in a bill ultimately. Do you think we'll get a full TCJA extension or not?
I mean, I think the votes are there. People are going to have their elbows twisted. I would say, thinking a little bit about what Erica mentioned for certainty and everything else, I would be willing, when they come talk to me, I would be willing to do a 1-year extension, and then let's get to the middle of 2026. Let's let the Trump administration. Let's look at the administration's policies. Let's get CBO and Treasury to give us a read on where we are, and then at that point, we can come back to this. Now, that's not that different from what happened at the end of 2010 when they were dealing with the 2001, 2003 tax cuts. It's not ideal, but with so much uncertainty around. And by the way, when I say let's do an extension, I'm not thinking about the Social Security, citizens abroad, consumer stuff. By the way, I'm still trying to work up a joke that'll get all 7 of those things without making fun of the people that are involved in that, but maybe for the next version. So, I mean, I like most people in DC, just like people in LA and New York have movie scripts. Well, I've got a plan too. I actually put a little thing in tax notes this week, and believe it or not, one of the things I'm pushing in lieu of the sea salt and some other things, I think we should revisit a corporate tax increase. And I think if I was to do a pitch to some Republican members, I'd say going from 21 to 25 helps you with Pillar 2, which is already out there. In fact, it may divert some tax that it's paid by big companies that would go to foreign countries back to our country. It helps you with 199A, not as much pressure to do that. It helps you with your 37% top rate. Maybe you don't have to do that because you don't have to worry about the parity between whatever the corporate rate and the other things. I think there's some positive things that come out of thinking about that. And I know there were maybe 3.5 Republican members on the Hill who at one point, maybe until they were sort of moved it to the back, who were actually talking about a corporate tax increase. I also think if we wait enough and think about it, the way CBO does its baseline and the natural flow of things, I think I could see a whiplash reversal and funding the IRS. There's a huge amount of money in there. We saw that when they did it in 2022. And I don't think it's a gimmick for Congress to say end of this year or next year to say, you know what, we don't really like what the administration did. We're losing so much revenue, hundreds of billions of dollars from compliance and whatnot. We're gonna do an about face and actually go back and fund the IRS. Now, it looks a little funny because the administration's basically ripping down a lot of that funding. But that's Congress asserting itself and taking a breath, looking at the real long-term consequences. So those are part of my package that I put in tax notes over the weekend, and now I'll yield to all the other taxi cab drivers who have plans.
Erica, I want to come back to Patrick's first point, and there's a couple of good ones in there that we'll discuss too. What do you think of the viability of a corporate tax rate increase? Is that something that is viable, and how helpful would that be in terms of making a bill that was revenue neutral?
I don't think there's broad support for that amongst Republicans. And I also think it'd be a step in the wrong direction. If you think about like the 2 goals that lawmakers should have for a reconciliation package, it should be fiscal responsibility and having a pro-growth impact. And you don't want the provisions that you include on the fiscal responsibility side to come at a very great expense to the pro-growth impact. And what we know about a corporate rate increase is that it is one of the most harmful ways to raise a dollar of revenue. There are lots of other revenue raisers, even base broadeners on the business side that would have less of an impact than something that is either a corporate rate increase or the equivalent of a corporate rate increase when we're talking about something like sea salt. So while I think it's good to brainstorm and come up with ideas for offsets, if we can prioritize the least economically harmful offsets, that helps both goals rather than coming at the expense of the growth impact. And on the original TCJA, the permanent reduction in the corporate tax rate is what drove most of the growth expirations from that. The certainty you get from doing a policy change permanently helps improve the incentive effects that it has on investment in the US. And if we start walking that corporate rate reduction back, that aids in increasing uncertainty. It increases uncertainty about the stability of the rate remaining where it is, which can have a chilling effect on investment itself. Just like we're seeing with tariff announcements, those before the tariffs even go into effect can have a chilling effect on investment. And that's not the place we want to be in.
Kara, can I just agree with something that was said? With absolutely a terrific result that was sort of brave to publish is that TF shows that the estate and gift tax relief has basically zero growth effects, and they also, surprisingly to some, find that a full SALT deduction, and now we're only talking at the individual level, actually has quite a kick. Maybe not as much of a kick as expensing, but it certainly has it fits in there. I'll just add one other thing on expensing for Erica. And as she knows, if you raise the rate, your expensing is going to have a lot bigger play. I mean, that was one of the interesting things that people have been finding out about TCJA when they go in and sort the things out. Combining the rate decrease in TCJA with some of the expensing actually blunted some of the expensing impact. Okay, that's enough. And I also have some land in Florida to sell you. So,
Chris, I want to do one of our last questions to you. Do you think we'll have one bill, or do you think this is going to be a multiple bill? Do you have a sense of if we're talking about timing, are we timing a bill that's coming in sometime this summer that really is, and we're doing this all again next year, or are we going to get this done?
Well, reconciliation is really hard. And I would say that I don't think we've ever seen successfully two reconciliation bills from two different budget resolutions in the same calendar year. In theory, Congress could complete work on this reconciliation bill and then move on to one for fiscal year 2026. It's actually quite unusual that we're working off of a 2025 budget resolution right now, because the process for 2026 is supposed to be happening right now. I would say, if I were a betting man, that either this gets accomplished by the end of the fiscal year, which we think, it's not clear, but we think might be a binding deadline for doing work on a budget reconciliation legislation that is based off of a fiscal 25 budget resolution. So either it gets done by the end of the fiscal year, or, and this has really been my baseline case, is that this is going to prove too difficult. The margins in the House are just very small. Usually you're talking about the margins in the Senate, but you're talking about the margins in the House being too small that you can't get people on board. My best guess is that there's a clean extension of TCJA at the end of the calendar year, and it's a bipartisan proposal. It's not through reconciliation. If they do accomplish reconciliation, that's probably the only bite at the apple that they're going to have, and the rest will be done administratively.
Erica or Patrick, do you agree, or do you have a different view?
I think he just agreed with me, but and Chris, if you're a betting man, by the way, there are now proposals to put a big excise tax on betting, particularly sports betting. So what the heck? Let's think about that. I think that just showed up this week, right? I mean, people.
Luckily, I'm not a betting man.
You're not going to take that bet. Erica, would you agree with Chris? Do you think that's kind of a logical timeline that we?
Yeah, and we've heard the same with some uncertainty about the fiscal year deadline, whether Congress could agree to somehow extend fiscal year 2025 through the end of the year so that they still get this bite at the apple with this particular budget resolution, if they changed the rules somehow. But yeah, either the end of the fiscal year or ultimately the end of the calendar year, so that we're not going into 2026 and having the majority of Americans experience a tax hike.
Well, it is going to be quite a lot to watch. We will be covering this throughout the course of the year. But I want to thank you guys for joining us today. This is a fantastic panel. Thank you to everyone that was viewing as well. We hope you enjoyed the program and you learned a lot. I know I did. And we'll obviously be continuing this discussions on this and other topics. We have another webinar next month that will focus on Pillar 2 and all the international interesting things that are going on. So thank you all. Have a great day, and we hope to see you soon.